Well, folks, there's a brand new risk on the minds of most stock market investors, and that's the idea that inflation could spike for a second time in 2023, just like it did in the 1970s. That would obviously throw off the current stock market rally completely off course and potentially lead for more pain for investors, particularly in the unprofitable and growth stock sectors. Yes, inflation's come down on a year-over-year basis, but it did the exact same thing in the 1970s, before spiking for a second time to a much higher level in 1981. That led to the Fed back then raising interest rates to 20%, crashing the US economy and throwing inflation back down to 3%. Obviously, right now, inflation is sitting at around 4 to 5% on the core PCE, and interest rates are only at around 4.5%, meaning there's potentially more downside if this inflation story plays out like back then. So what exactly are the realistic chances of inflation spiking again, and what effect could that actually have on the S&P 500? That question is exactly what I'm going to discuss in this video. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, I think we need to look directly at the labor market if we want to answer that question. As you can see, unemployment last week came in at a record low that we have not seen since the 1960s at 3.4%. And this is the number one indicator that the Fed is currently using to decide whether or not inflation is coming down and how much effort they need to put in on interest rates. But if you guys paid attention to what happened at the FOMC meeting last week, you'd realize that Jerome Powell and the rest of the committee have slowly started to realize that this unemployment number doesn't directly correlate with inflation on a headline basis. And the reason for that is pretty obvious. Inflation from June has fell from 9 to 6.4% on the CPI index. Meanwhile, the labor market continues to get tighter and tighter, meaning there's still job growth and there's still people looking for jobs that are typically at much higher salaries than we were a year or two ago, even though we're seeing so many layoffs in the tech sector. This is leading many investors to ask this question: how could this possibly happen where unemployment is going down, but inflation and prices are starting to stabilize? Wouldn't this mean people would spend more money and that would cause prices of goods and services to start going up? Well, not exactly, and here's why. First of all, you see, the unemployment rate doesn't actually take into account a majority of the white-collar jobs, whether that be in the tech sector or the software space, where you're seeing so many companies currently laying off people after overhiring in 2020 and 2021. Most of the jobs that the unemployment rate represents are small business-related jobs, whether that be on the government side or private-owned companies, whether that be restaurants, retail stores, or other travel-related venues. Those jobs have actually grown substantially because the pandemic locked so many people down, and now people want to rejuvenate those experiences that they missed out on. This has led for the demand for workers in the carpenter, construction, and medical spaces to skyrocket, leading to more job growth than most analysts had expected in January. And this is why the unemployment rate is not going up. And this does not necessarily mean the inflation rate does not have to come down. It can come down because most inflation was caused by tech-related spending on durable items, which itself was driven by stimulus checks and quantitative easing in 2020. When people all of a sudden got $1,200 into their bank account, they were able to buy things they never thought they could. They didn't have to take credit or debt. They could just spend extra money on goods that most of them spent in the short term. Whether that be in the holiday season of 2021 or 2020, people went out and bought items like crazy. As you can see, that led to the durables inflation component of CPI to skyrocket throughout 2021 in blue, along with the non-durable components as well, which consists mostly of oil and food. And this is what the market and investors don't realize. Both of these were caused by different events. The line in the black was driven by people being locked down in 2020 and now wanting to spend time outside. People were able to go out and spend money on restaurants, outdoor dining, travel experiences, whether that be going on flights to vacation spots or going to Disneyland. And the blue was mostly caused by the heightened demand for consumer electronics, people spending more time at home, working from home, and spending money on their house, whether that be for appliances or services. And guess what? Most of this inflation in blue was not caused by Main Street, by small businesses, retailers, or restaurants. It was driven by the tech sector, which boomed throughout 21 as people spent more money, as corporate profits went higher, and as the companies hired more and more people with higher salaries. What that basically means is that the inflation we're experiencing today is not systemic inflation driven by a poor economic system. It was driven by temporary stimulus into the economy injected at a time when supply was lackluster, given the closure of factories and blue-collar workforce. That's what caused inflation to spike. People no longer had the ability to manufacture goods that were in high demand because of the insane stimulus checks and quantitative easing that was pulled out. Interest rates were at record lows that led people to be able to borrow money at cheaper rates, which also caused a wealth effect for most investors. And basically what's happening now is the exact opposite. People have run out of excess cash, savings rates are at all-time lows, and corporate profits are starting to decline and return to their mean. And no, that does not necessarily mean the unemployment rate has to tick up for that inflation to come down. Most of the tech sector is not represented by that number, which is typically calculated by the Bureau of Labor Statistics through only 60,000 households across the US. And depending on which part of the country you ask to, most of those households do not necessarily work in the tech sector. Again, they are mostly blue-collar people. But I'm sure the question on your minds now is, what exactly is going to lead us to the second round of inflation? Yes, unemployment is at record lows, and that's not necessarily going to lead inflation to not go down. But that doesn't necessarily mean we can't see another spike driven by an external factor like we did in 1979. Well, luckily, I have some good news that shows us the situation today being a lot different from back then. Back then, we had an oil shock that was driven by the Vietnam War, which led to actual price controls led by the US government. At some point, those price controls had to be lifted because obviously that would cause economic mayhem and reduce entrepreneurship in the country. And when that did get lifted, that's what caused the second round of inflation. Yes, we do have a war today with what's going on in Ukraine, but the US is not directly involved with that specific type of battle. That did not necessarily cause inflation to skyrocket because of oil prices. Instead, as you can see, back in the 1970s, most of the inflation was actually driven by housing, food, and medical expenses. Whereas today, that distribution is a lot more even, whereas transportation is actually much more even between the two, which shows us exactly why CPI has been coming down, because a big component of it was oil prices. On top of that, the real interest rate back then was significantly higher than it is today, meaning businesses could not invest appropriately in the capital infrastructure needed to increase production. And when production is tight, that means that each dollar is going to produce less items, which in turn causes inflation to skyrocket. And obviously, as we've seen in the GDP data, right now we're not actually experiencing weak economic growth. Back then, the unemployment rate was skyrocketing, and Nixon actually wanted it to come down by stimulating spending, which itself caused high inflation. Today, the government and Jerome Powell don't have to worry about that situation because the labor market is already so tight, and companies are still innovating at an insanely high level. Profits are still higher for most companies than they were in 2020 and 2021, meaning that the government does not need to focus on inducing economic growth, which could lead to the second round of inflation. Now, don't get me wrong, there are some risks that could lead to a second spike in headline CPI, particularly driven by the services sector. Because of that tight labor market, services inflation has still stayed elevated as people are spending more on services that they missed out on throughout the pandemic instead of durable goods. But obviously, those kinds of situations are out of our hands to predict as investors. All we can really do is look at the current data and understand how it is similar to what happened in the 1970s. I hope this video shed some light on the situation, the differences, and the similarities between the two time periods, and I hope it makes you make a better decision as a long-term investor in the stock market. But as usual, guys, hope you enjoyed this video. Let me know your thoughts down in the comment section below, and I'll catch you guys in the next one. Take care.